Hello, everyone. Welcome back. Hopefully, we'll do better this week than we did last week. I had a major technology problem with sound and all sorts of things. I'm not sure if it was my fault. Probably was. But I think my Wi-Fi is very strong today. Back home in Tampa, and hope everybody's had a good week. So let's get going. And I was proposing a topic this week we can get into if you want, and it was the idea of maybe I'm just going to try to put it in my own words. Maybe doing some back testing, doing some research, and deciding that you're going to uh, maybe not pay full attention or implement the best ideas that you found in your research because you have some particular um, ideas that you don't really like certain aspects of the systems. Obviously, the drawdown is too large. So maybe you will, on purpose, choose a strategy and a set of rules that are not the best, and maybe because you want to make sure you can follow the system. And it was a paper, a post made by our friend George, and I think I posted it last week, and maybe someone went out there and read it besides me, and that would be something we could talk about. Is that a good idea? Is that a good mentality to have? To always, and I think he was quoting Ed Sakota as sort of saying, there's no best system. Choose the system that's best for you. And I think that's just fraught with, some possible problems and issues. But anyways, I want to hear from our friend Oleg. Good morning, Oleg. Good afternoon.
Good afternoon, good morning, Jerry. I'm now near the great sandy beaches in the South Russia, in Anapa, Krasnodar region. I already was here for a few months in March and in February, and so it's not my first hour and following meeting from these places. And I have a mood now for these places to be in a desert near the sea, in the lonely beaches, because it's not so warm, it's not hot. So okay, I am of course very happy to be here, and because I have a lot of experience. I'm not talking about successful experience. I have also a few years successful experience, but a lot of trading experience. And I want to say that of course we as a human beings, we organize in such way that we want to do something that is smoother, that is more laziness in it, more comfort in it. But in everything, to be successful, we must to train ourselves. And of course, we have this. We can make our decisions about the system. There are different strategies, of course, but if you have chosen a strategy, first of all, you must not think about your comfort. You must think about. I'm not talking about only trend following now. You must think about core principles of the strategy. If you have chosen a business strategy in business, in marketing, in sales, you must do what you must do according to the strategy. And in my Twitter, I had a quote that I wrote this and I had this analogy. I was thinking about this, that it's like a boxer that will say, I don't want to prepare for championship by going to gym, by training, by feeling pain, by doing something that I don't want. I want to watch films about boxings, about fightings, and I will be trained mentally, drinking beer, and do nothing, and I will fight because I will be champion of the world because I'm mentally prepared for this. I have seen a lot of, and I have read a lot of books about sports, maybe 100 books about sports, and it's my way, yes, but it's the way that will not. It's a proven way that will ruin your career. You will not be a champion So it's, I think, the main thoughts here in this direction.
Yeah, that's certainly the way that I've always approached things. That's sort of the way that I was taught, that it's kind of quite the opposite, actually, that the best trading ideas and the best way to approach a system development is to expect the things that work to be sort of psychologically painful and difficult to do. Um, and so I think it's just sort of a interesting idea that the markets are so tough and they're so um, fraught with danger of protecting your capital and not missing trades, that if you choose um, the best ways to trade based on your back test, the best that you can do, the best that I can do, and then you might survive, right? And then, well, let's just make it a little bit worse because I don't like big drawdowns. To me, I'm just a little like, wow. Then I think I posted another tweet yesterday from Rob Carver, and he said, frankly, this just may not be the business you should be involved in if you taking losses and sitting with drawdowns and volatility is obviously part of what needs to occur to some degree. And I just think that having this mentality that the market should accommodate you, give you money, and make it the way I like it is a bit much. And then a cousin to this argument, I think he mentions in his article, is there is no best way to trade. There is no best approach. I'm not sure how that fits into anything other than, we always try to strive for doing the best we can. And I do think there's no reason to get too uptight and think that there is the perfect approach, but there's obviously the best, right? I don't have it. Maybe the guys at different firms have it. Renaissance, they have the best probably, and some others. But it does exist, and we shoot for that. So I don't really understand that kind of. I don't think we should shoot for perfection in the sense that we're paralyzed and we can't go forward, or we're depressed because we have drawdowns. But I don't really know what that means. I'll scan the article again while someone else speaks.
I'm sorry, I want a few very fast. I want to say that no extremes. I think no extremes. I mean that if somebody will say that he knows a perfect approach, it's very perfect, so it's extreme for me. And I will say to him, okay, show me at least 100 years evidence-based track record, evidence-based, and logic behind that track record that will make me sure, because I have heard a lot from different traders. I have a lot of ideas of a perfect approach, and even one guy said to me that he has a secret in his firm where he trades. His mentor gave him a super secret system, and he gave the system for me, and he asked me not to give the system to anyone, short-term intraday system, and he asked me not to show the system. And I really can't show the system to anybody because I have forgotten the system, and I don't remember where he has sent them, where it is in email or maybe in Telegram. I don't remember. So because I'm not interested in this because it's not fit my personality in the way that I know the core principles of trading, and I think I know the core principles of business, on the business side. And I haven't seen any success that looks like maybe, I don't know, maybe success in writing or maybe, I don't know, maybe something like this, maybe painting pictures, maybe this, but I'm not so sure even here. But our success forces us to be disciplined, to do the things we maybe don't want to do, and to train ourselves to be comfort in this uncomfortable to many people circumstances, and because of that, a lot of people who are doing something different from other people who are doing their businesses and doing a trading, they see that other people don't understand them, and because of this, because people want comfort and want money every month, want comfort, but in fact, this model where we see comfort, where we see money every month, and so on and so forth, is very fragile. It's very fragile model because I see that the world is not organized in a such way.
Hi, everyone. Hi, Jerry. Good to be back. Sorry I wasn't here last week. Yeah, this is a good question. You often hear the trade according to your personality. Well, that doesn't cut it for me, because what that inevitably does is effectively make you adopt average behavior. And it's also contingent on the fact that an edge is easily available. In other words, if an edge is so easily available, then there are so many different ways you can trade that edge. You can afford to compromise in accordance with your personality, how you should trade. I don't think edges are that easy to come by. I think they're very difficult to achieve on a long-term sort of sustainable basis. I think we can see with trend following how the process is very counterintuitive to what our personality would like. And I think that predominantly is why there is such an enduring edge with trend following, in that it is so against the personality or the psychology of the human being. I think that is why it is such an enduring edge. So therefore, I don't think we have the luxury to trade how we'd like to trade. This edge and trend following is through making very hard decisions that are psychologically very difficult to do. And that's why we adopt the systematic rules-based process, to avoid the need to let that brain or that psychology or that personality interfere with the process. So, yeah, I'm very much a supporter of the view that we trade what the market delivers, and the market doesn't deliver a comfortable ride for traders. And you've got to sort of understand that it's the market that delivers your fortunes, and the market can be very badly behaved for very long periods of time, and we've got to have the mettle to be able to stand up to that. And with our rules-based process and our long-term back tests, the entire reason for the adoption of those principles is to develop sustainable guidelines that mitigate risk over at least what has been observed historically. And therefore, if we have a system that we know has been put through the hoops as far as what has been delivered, across different markets over very long time frames, we've at least got a robust method that is allows us to deal with this sort of market hostility in the future, and all the possible outcomes we could get.
Well said. I mean, I think everyone has the line, everyone has a line that you can cross where they'll change their opinion. Frequently we hear, well, if it's working for you, then that's great. But now if someone said, I'm counter trend and I concentrate on the S&P only, I don't like diversification nor trend following. Whoa. Maybe that has worked for you, but I don't think that might work in the future as well as it has worked for you recently. So then the opinion would change if you cross that line of someone who, well, I really love diversification. But it's almost like, well, if you're doing some trend following, if you're doing a lot of diversification, then okay, if it works for you. But I know historically my systems have had some fatal flaws. That it did work for me. I was very confident. I really liked the systems, but I had some issues with them that popped up in 2008 or in a real crisis period where I wasn't protecting capital enough. My rules were forcing me or allowing me to trade too large and too concentrated with too much leverage or whatever. And I think, leverage is the one issue that we can all say, yes, if we all have this great, wonderful system that's highly robust, a great back test. It's been approved by an approval body who is worth approving everything and saying, yes, you have an A-plus system. Then we could all trade that system based upon our personality as it relates to risk and leverage. I could trade 5 units, you could trade 10 units. Someone else would trade 2.5 because they don't like too much volatility and drawdown, absolute drawdown. There's still going to be the same relative drawdown as relates to the max profit or the profit. So I think that is the one area that I will say yes. And all things being equal, I've said many times that it's always best to trade as short term as possible, as long as it doesn't sacrifice profit and consistency and drawdown and commissions and slippage, and you have the proper expenses built into the back test. And you can devise a system. It's easier to create rules for me that are longer term in nature. And I'm afraid to get too short term based upon the commissions and the slippage. And I think the long term stuff for me might weather better in the future.
And I want to say that we see in almost all fields, then we can see near 10% of the people who are truly successful in the field, in every field, maybe in medicine, in business, in science. 10% of the people who are in the top of this. And maybe they're not much smarter. Of course, they're smart. But in other 90% of the people, there are a lot of smart people also. They can give good arguments. They read a lot of books, watch interesting videos, maybe. Not all, of course. And I want to say that that discipline and loving what they do and their ability to never give up is what makes these 10% people the top, being in the top 10%.
It's very interesting because, when I look at, statements such as, well, if you're doing well with how you're trading, then keep on going. You've got to ask yourself the question, if they've been trading that way, let's say for 2 or 3 years, what does that really mean anyway? I mean, you've got to assess things in terms of 20, 30, 40 years to basically have any degree of confidence that the way they're trading has any sort of merits to it or any level of robustness to it. And, like a classic thing is we might have a track record of 20 years before we realise that a particular program or a fund manager has weaknesses that, weren't ever observed in that 20-year track record. A really good example of the Fort programs that I've been monitoring, they've had 19, 20 years of magnificent performance where, they were very closely aligned with the trend following index, and you therefore naturally assume that they are trend followers. However, you clearly see in the last, 6 months, 8 months, this significant nosedive that these programs have done, where obviously they were doing something different to what the trend following community was. That they were delivering these lovely smooth returns that everyone loves, in accordance with the principle of trade according to your psychology. They were delivering that perfect outcome for their traders, yet they were not robust. They've been, and it took 20 years of history for the market to sort that out. But this is inevitably my concern in relation to these statements regarding trade according to your psychology. I don't think so there are so many people that have gone to the trader's graveyard with, total collapse and total risk of ruin. I don't think there is this luxury to be able to make a statement like that because it is an incredibly hard game. And I think people totally underestimate how hard it is.
I want to say that important thing. I want to say that great trader Jerry Parker said once that the experience, our successful experience, can be not very useful for us and not very good for us in some circumstances And it's very interesting thought that maybe, of course, it was such an environment where we were, it's my comments now, that in an environment, and I know this, environment where we are high leveraged, non-diversification, doing a lot of discretion things, and it was very good environment for all of us, for trend followers and non-trend followers, maybe, I don't know, and people and the person understands that, okay, I did a high leverage, I not diversified much, and I'm successful, so I will keep doing this, and sooner or later he will lose his money because he is not doing the right thing. And it's a very, very interesting idea, a very interesting thought.
Good morning, Michael. How are you?
Hello, guys. How are you? Okay, back after some work. Okay, I have this question for Jerry and everyone else. If you have seen this before, I'm testing some trend following strategies because I naturally, I have to get back to futures trading the way things are going after a long time. Actually, I started as a futures trader, T-bonds and currencies, then moved to stocks like, everyone else. So I have this situation where I am long Brent from November 2020 and short crude oil. Have you seen this before, Jerry?
Yes. So you put a spread on.
Yeah, yes, exactly. Well, the system I'm testing, I have two systems. So one is the breakouts, so, the standard breakouts. The position size is based on volatility, of course, and the ATRs. And it's long Brent, long, of course, US dollar index, short of the DAX, it's short the Euro stocks, the bonds, it's long the orange juice, the short the cocoa, short the silver, short the copper, short the gold, long the feeder cattle, short the crude oil, and long the live cattle at the moment. Anyway, I'm testing these systems because we all have to think seriously about the future, the next few years. And as I have been saying, and I also wrote some articles, even in strategic allocation, the future is like stocks and managed futures, 60-40. And we have to look seriously. Now, Jerry, you mentioned scaling before. Above a certain AUM, this is possible. But for people like retail, with the small accounts, the scaling in trend following is not possible. Do you agree?
Yes, I agree. It would be very difficult, depending upon the size of the account. In those markets you mentioned, maybe your maximum position might be one lot. And I trade 4 systems, so I need at least 4 to be able to scale. But it sounds like you have a good portfolio, and I have a lot of those same positions, of course. And I think your short crude is not a spread. It's just crude is a little bit weaker and hit the downside breakout. So you're short crude and you're long Brent. So I think that was my mistake. But yeah, that's a benefit that we've talked about before in trading multiple markets that are sort of correlated. You can get different positions on, and the correlations sort of evaporate when you overlay the trend following. It's kind of funny because I read a tweet this morning, and it was the person was serious, and they said basically, are you doing something wrong if your P&L is increasing? And so this just is a great example of how we live on different planets when it comes to investing. The trend followers and the people who are committed to diversification and trend and commodities and currencies and anything other than just stocks and bonds. We, of course, if we weren't making money, if we were for it, yeah, we're definitely doing something wrong. And when we make money when there's no trends, we're definitely doing something wrong. But in this world we live in, which is dominated by a singular focus on long equities and buying the dip, and this type of religion that is so far from good math, they're questioning us. And so we would question other trend followers in the same way. But yeah, to them, if these people are making money, they must be doing something wrong. It's a little bit funny and just shows the gulf between systematic, diversified CTA trend following and everyone else.
And I want to say that I have wrote this in Twitter already, that a few years ago I saw maybe 2-3 years ago, I saw in the net one guy, he is a fund manager, and it's not a joke, it's a real fund, London-based firm, a young firm, but he said that he combines his fund combines Elliott Wave's theory with the book of Ray Dalio Principles. And it was like a joke, but it's not a joke. It's serious. And by the way, I have read the book of Ray Dalio Principles, and I don't remember, maybe I have read not the full book, but I don't remember anything about the trading there. It's his life principles. Maybe another edition of the book is about trade. I don't know, but it was even not funny because it's real money, and I thought real money there. Somebody invested this. Somebody invested this thing. It's real money there. It's very interesting and not funny.
Keep going, Michael.
All right, Jerry. Have you seen this paper, Position Sizing Methods for a Trend Following CTA by Henrik Sandberg and Rasmus Ochman?
I don't remember that, no.
It's excellent. I'm trying to go to the nitty-gritty. I'm trying to experiment with different position sizing methods, and we have like equity curve-based, target volatility, correlation, omega optimization, maximum drawdown, dynamic stops. For now, I'm using the basic method based on the risk per contract, based on the ATR. But I'm looking for something better.
Well, that's what I've used for 39 years. So let me know if you come up with something better. I mean, I love it. And I like looking at the trades on a trade-by-trade basis and implementing my approach, doing the right thing, following the system, trade by trade, focusing on those trades without regard to overall equity and what other markets are doing, building on this approach that you can build a large sample size in the back test and doing the best you can. Now you have to set your leverage and your portfolio up, ahead of time in a good way. So you're allowed to do all of the trades and treat each trade individually. And then, of course, at the end of the day or the end of the year, having done that, there's your performance. But not trying to manipulate that performance and reduce or increase any of the trades based upon what's happening in the portfolio. It's this single-minded approach of just focusing on the trade the way the computer did, and then just seeing what happens. And the key, I think, to trend following or systematic trading is, well, one of the keys, because I say it's the key on many different things, but one of the keys, one of the most important things is treating every trade the same way. Now, I understand that you can't do that all the time. When all hell breaks loose in February 2020, you may need to reduce positions across the board. So once or twice or three times a year, you may, or once every 1 or 2 or 3 years, you may need to step outside of the system and exercise some across the board risk management. But I try to set my systems up so I don't have to do that. Certainly not very often. So this focus on each individual trade and ignoring everything else, correlation, increased fall, portfolio, what's going on in my portfolio. I'm focused on doing each one of these trades the same way every day for the rest of my life.
Very, very important, and I want to say that it's one of the most important information about trading. One of the most, of course, not all, but I think that a lot of people don't understand. It sounds very easy to focus on the trade, to do the same things. It sounds more easy, more simple than to do different things. But in fact, we must train ourselves, and here is an issue that we must really train ourselves. And I'm talking about myself. I'm not talking about maybe any other people. It's not a problem. I don't know. But for me personally, it's really, I trained for a few years myself to do the same, to be disciplined. And when you saw this drawdowns or when, firstly, I learned to handle the drawdown maybe 10 years ago, more or less, I learned this. And after this, I learned to handle the trend. When I follow the trend, I must follow this, not cut my profit. It's more, by the way, it's for me personally, it's was more difficult to not to stop the trend, not to stop trading when it was trading period than handling the drawdown. So I want to say that it's very important, and yes, it sounds simple, and of course often Jerry said this, Neil said this, often said this, but because it's one of the most important things in trading, and of course it must be often said, it must be, because it's very, 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 for me personally, one of the core principles. Without this, I can't see systematic trading. And it's not simple, as I said before, minutes ago, as it it's not so simple. In fact, when you do this.
Mike, it's very interesting how you're looking for these different forms of position sizing. Look, the way I see it is that I think these more complex forms of position sizing, such as Kelly criteria and all of these things, are more applicable for convergent methods, which are targeting the edge in the bulk of the distribution of returns. But where we're targeting, which is these tail regions, I think this is what I'd regard as an information deficient region. In other words, there is no stable mean in the areas that we like to target, these outliers. There is no stable standard deviation. Because of this information deficiency, I think we need robust, simple methods as opposed to more what we'd like to do is obviously have, more complex, comprehensive methods. But I think that actually goes against what we're trying to achieve here in this tail region, where some of these major material moves, all we know is that they might have very large directional extent. Their levels of volatility could be anything, and the way they define their trajectory from entry through to exit can be so many various different forms that I believe that you need sort of more robust system measures as opposed to definitive calculated position sizing methods and treatment and dynamic position sizing and all those things. which don't necessarily work well in the regime we're targeting, but they do probably work well in the convergent regime, around the mean of the distribution or the bulk of the distribution, around that high kurtosis or the peak of the distribution of returns. Those complex methods work very well, but they don't work well within our tail regions.
I want to say that maybe I'm thinking about rules based, and as I remember, Richard said that ORs can be good traders because I'm a lawyer by my profession, by my education, and in university I was taught to be rules based and how to do this. Maybe not perfectly, not in perfect way, of course, but. And I think that we must, to be effective in many spaces, in many fields, we must be rule-based. For example, drive a car. We can't drive a car. We can, of course, but there's car traffic without a rule-based. Maybe it looks even better without rules. I don't know. But in fact, it will be a lot of accidents, a lot of problems. And of course, yes, if a guy not rules-based and he wants to get faster from point A to point B on a car, he will have a very big speed and no rules, and maybe a few times he will be very fast from one place to another. But in the end of the day, sooner or later, he will be in a car accident, and so it's something universal to be rules based. I'm talking about this, and of course, like Jerry said, we must have good rules. So rules in driving, it's rules that are proved by evidence-based rules, proved by practice, and laws, a lot of laws, not all. It's not all laws, and it's very bad, not all, but good laws, they are based on real people behavior, real people situation.
Richard, excellent. I agree 100%. And I have my doubts about the use of optimal methods, even for convergent methods. Not because only of non-stationarity, you don't know the win fractions, the payoff ratios, and even the standard deviation of returns. But my work, and I have written some articles on this, even for convergent mean reversion, the best way to deal with risk management is at the higher allocation level to the strategy. Like you are going to allocate like 5% to this particular strategy and then go 100% position size, instead of trying to do the optimal, which turns out to be suboptimal. That's one. Now for Jerry, I have done some simulations because, for us, for instance, I'm not managing any money. And for the individual type traders, I want to know what's the minimum account to do trend following, and what's the minimum number of contracts to have a decent diversification. And maybe Jay, you or anyone else wants to input to here, to provide some input. I have determined that 25 markets is like a good size, and the minimum account is about 1 million. Below that, you don't have flexibility. You may be missing trades, especially when you are sizing based on volatility, and this is not this will probably break the system eventually. What do you think?
Yeah, I like that. I think that's exactly how I started in 1984, about 25 markets, 1 million. And I was trading very large though. And we were making, about 200% a year. So I wouldn't recommend that part, but it sounds good to me. Now, Richard and I, we would not vol manage or correlation manage. We're going to let those profits run. So everyone has a slightly different way of doing the trend following. I think another important concept is to trade a fixed universe. So as your assets increase, you add more markets, but you try to keep the same markets that you're trading all the time. Once again, why? Because we're trying to do the same trades in the same markets in the same way for the rest of our life. So you don't want to kick out the British pound because it sucks and then you put it back in. You know, you're paying a tuition and losing money by trading some of these markets. And if you keep them in there, they'll eventually have a big trend. And so you'll disrupt this consistency and this discipline, even by taking markets in and out all of the time, and certainly by having a technical calculation, a relative strength calculation on constantly changing the portfolio based upon some sort of rule. And then just back to what you were saying earlier, I just want to hammer home this one concept that I'm totally committed to, and that is whatever formulas you come up with and systems you come up with, it's really, as long as they're pretty good, it's really a situation that it's forcing you to be very consistent and treat all the markets the same way. So if you don't come up with the perfect sizing formula or the perfect breakout or the perfect trailing stop and stop loss, it's still, if you're committed to doing that above average system for the rest of your life, then you're going to be in a good situation just by being doggedly consistent. Now, over time, improvement happens, and then you'll be doggedly consistent with the new tweaks and changes that you've made. So, but I think the most important thing is to start that trading, start with the amount of markets that you have, and find that $1 million and just get going. Now, frankly, I think that another thing I would really highly recommend, obviously, is to trade single stocks and just choose the best you can, a few single stocks that are diversified, just like you'll have a few currencies and a few commodities and a few interest rates, and try to stay away from the indexes that will not have a tendency to yield the type of outlier trades that a single name would.
By the way, very good. I understand this. I'm a little expert in this because I know how to trade with small accounts. Have experience in this. So, of course, yes, I think that minimum it must be 20-25 markets. And as for me, I try, as I said before, choose markets with a low probability of correlation. I'm not talking about non-correlation, but low probability of correlation because we don't know where the correlation will go also, but low probability. And then, of course, a very great idea of Jerry now, he said that to choose individual stocks, because when we are talking about stocks that are including index SP500, for example, that SP500, these main stocks, they're very highly correlated. They're very highly correlated, and
Go ahead, Michael.
Okay, yeah, excellent. Thank you, Jerry. Yeah, absolutely, I agree. And the systems trend following are basically simple compared to statistical arbitrage or long short. The value comes from the consistency, as you said, and the discipline. And if you are selecting markets based on performance, that's basically selection bias. And I keep seeing, I have a few contracts that are net negative, but I keep them because you never know. You never know. Maybe they will provide the outlier in the future, and also correlations that Oleg mentioned, I don't pay attention. Correlations are random in the markets. Like in 2008, everything moved together. Statistical arbitrage people, they got wrecked. Everything, the short and the longs, they both went down and they lost a lot of money. So I don't pay attention to, the correlations. And also, with these correlations and the covariances and optimal portfolio management, I always ask these people who promote these, what is your look back period for calculating this? Is it 252 days, 120 days, or the whole price history? I mean, they don't have an answer. It's all theoretical. It's like an abstract model that may not work in real life. Is unforgiving when there is randomness. So I don't pay attention to correlations. Now, as far as the individual stocks, I prefer to do this the long short than trend following, because unless you have some pre-filter to choose stocks that they have good behavior with, as Richard calls them, divergent algos. For instance, look at Tesla. Tesla is at, I think, new all-time highs. It had a period of like, how long? Let me look here. Maybe 6 years of sideways market. I mean, no trend following. There is no trend following systems from 2014, 6 years, to 2020. The stock moved sideways, basically. No outliers there. So that can have a large negative impact. What do you think?
No, because I wouldn't look at Tesla or any market in that way, because I'm doing this back test on lots of different markets, and I just want to come up with some good rules that help me, and I want my systematic approach in these rules to produce a good, healthy, average trade profit, and then I'm going to look at my win percentage. I need that to be in the high 30s, low 40s. And I'm going to take the knowledge that I get, having back tested hundreds of markets over decades. And if a brand new market happens, then I'm ready to go. It has no data, or maybe just a year's worth of data. But I'm relying on this back test of lots of different markets because I'm committed to trading all the markets the same. And new markets will be treated the same. And I'm going to expect that expectation per system is for all the markets, not just the ones I back tested. And just like you were saying earlier, if you look back at performance in these markets and only choose the markets that have had good performance, then that's overfitting and that's random. Well, that goes for Tesla too. Kudos to you for trading Cocoa. It has a horrible track record recently and probably over its entire period. There's going to be some markets, I don't care how many markets you test, there's just going to be some markets that are the best and then some that are the worst. And that's just random. It doesn't have any information for the future. So I never look at historical performance. I only look at markets to add to my portfolio in the terms of how do they add diversification. And do I think that they have a chance for a good outlier, which I think every market does, except for these indexes that are averages and are composed of many different markets. But I think, oh yeah, another thing I wanted to say is, yes, you're correct that these trend following systems, at least mine and everything that I believe and advocate for, should be relatively simple. But the reason that they're simple is because we're very concerned about counting the sample size of those trades. And with too much complexity, i.e., rules, we keep whittling down the sample size. And it works. So if it didn't work, if the simple systems didn't make money, and then we would have to become more complex, and there would be a problem. So what we trade is complexity for robustness, and the downside is we do get bigger drawdowns, especially in open trade profit, which is a good trade-off of protecting capital, taking small losses. So we want those drawdowns to occur on trades and at times where we're very profitable.
Mike, my thoughts are that the reason that I'm a big advocate of breakout models is that I don't think there's a one size fits all for any type of trading system. So, for instance, I think divergent models are capitalizing on these tail regions of this distribution of returns, and that therefore means that we don't want to be participating in the market when price moves are not extreme. In other words, the signals that are generated by our models occur when price moves are extreme. So imagine if you had a universe of 100 markets. There's a very good likelihood that the vast majority of them wouldn't reach that level of extremity to activate those signals. It's only those signals that are activated that make us participate in that market. And the time that those entry signals are active is, we'd like to think, is the entry signal is getting towards the tail region of the distribution. And when you get closer to that tail region, you lose information that you can use to reliably model your system. And that's why we use these very simple, robust systems with no profit target. We have what we call a loose pants methodology to allow maximum freedom of movement of the trend. We're not sort of using complicated algorithms to manage the process between entry and exit. But at the point of entry, when we get that signal, we are hoping that we are at that tail region. And if we are at that tail region, we find that maybe 5 or 10% of our trades make our jam. 90% of the trades are effectively noise to us. They're effectively, linear wins and linear losses that ultimately balance themselves out, the 90%. But it's the 10% that make our fortunes in this divergent world. And therefore, we've got very little information to work off. We've only got 10%. And in that 10% region, there is no information apart from the fact that we've had some sort of outlier that has driven price within a directional anomaly, and we've been able to participate with that with our trend following system, our simple trend following system. So things such as correlation don't enter the picture, because correlations tend to be, if you're looking at the Pearson correlation coefficient, that's applicable to 95% of the market data, 90% of the market data. We're not looking at that. We know that in the tail regions, correlations break down. We also know that they're non-stationary. We know that there is no single mean. We know all of these things about these exotic sort of price moves in this tail region. So we are deliberately simplifying our system because there is no valid information we can use to make our systems more refined. So on that principle, we're using a very diversified method. And interestingly, when I look at, Markowitz, and I look at what is the level of optimal portfolio allocation with modern portfolio theory, they're dealing more with, a generic statement across the entire distribution of market returns. And they're saying that, when you get to levels of maybe 25 to 30 assets, the marginal benefits of diversification decrease. But we don't find that in our trend following world, because The outliers are the things, these nonlinear anomalies, they are the things that contribute to our vast fortunes. And they are not represented in these models, such as modern portfolio theory. They are absent from those models. They treat these outliers as anomalies and they exclude that from the data. But that is the stuff we are actually hunting. And therefore, when you look at, modern portfolio theory and they say that there is a maximum level of diversification, when I do my research, I find that as I'm slowly increasing the levels of diversification in my portfolio, my CAGR is actually increasing. It's not that I'm getting better risk-adjusted returns because my drawdown is reducing. It's a combination of two factors. One is the CAGR is increasing and the drawdown is reducing from increasing the levels of diversification. You said a very good point. You said there is a lot of selection bias, cherry picking that goes on with portfolios, and I totally agree with you, because what I find is that if I'm I have a possible portfolio of 100 markets and I only choose 10 of those markets for my portfolio. Those 10, some of them might not have any outliers in them at all. And so therefore, they're not contributing to my overall portfolio wealth, my CAGR of my total portfolio. But as you increase the level of diversification from 50 to 60 to 100 up to Jerry's 200, you're continuously getting this CAGR benefit from the outliers being delivered by the sample that is getting progressively wider with no hindsight bias. So, I just see diversification as an essential tool for trend following, not just to reduce the level of drawdown on the ensemble of returns, but more importantly, it's building CAGR through the fact that we are getting a broader distribution from a selective sample that is only targeting outliers. And with this broad diversification, we're getting a better distribution of outliers in our portfolio sample.
Very great, very great. I'm impressed really, because of course, if we are talking about the math side, simple math here, if we have only 10 markets, of course, the probability that one of them will have a big move, will have an outlier, is lower than if we have 100 markets. And of course it is so, and I like this, that 90% of our trades are maybe not awesome trades, but not outliers, of course. And I think that I worked in sales, and I saw the same situation when, if you call to a person, to a business person, and offer him your commodity or something like this, or your product, and 70, 80, or maybe 90 will say no, depending on your product. But this 30, 20, 10% will pay off. And it's the same situation. So I'm very impressed of all you said about this distribution, about this. We see in the terms of probability, when you said it, Richard, it shows in terms of probability, in terms of math, in terms of science, in terms of common sense, it shows us. Thank you.
Good morning or afternoon, Absolute. What's going on?
Hi, guys. Yeah, I haven't contributed in the last 2 or 3 meetings. So I was just, when we mentioned cocoa and markets that are amenable or not amenable to trend following. So a question popped up in my mind. What, for Jerry, can you envision a world or a market in which outliers can exist and will exist, but the size of your initial stop and of your exit are such that will make you either get stopped out before they continue or kick you out sooner than they end?
Yes, I can. Without a doubt. I think that that's always a possibility. That's why I've never really agreed with people who will say things like, there are always trends, there will always be trends. because sometimes they'll say, well, wait a second, there were a lot of trends. Why didn't you make money? And I think we're always doing battle with this choppiness and these collapses and these tremendous sell-offs. After years of profit, we can lose it all back very quickly. And so I think that is definitely a problem in a world that I can't envision. I don't think it is likely or something that can be predicted necessarily. Now, if it continues to happen, and they're kind of two different things, right? You have these, you have this choppiness, and so you need, and you have a stop loss, and you want this stop loss to be far away, so you don't get whipsawed a lot, and then you want the trailing stop to be far away, and then because you don't want to keep getting knocked in and out and having to change your position size, it's going to get smaller and smaller as the market goes up, probably. And then all of a sudden everything crashes. So what we see recently is we see some crashes and we see it keep going, and then we see some crashes, and then it go back right to the highs again. So sort of a coordinated effort where we just have this continuous change in how the markets are behaving. We haven't quite seen that yet, and it's difficult to coordinate that. But if there was some sort of fundamental change in the markets, we had a fundamental change, I believe, in the 90s, where the short-term breakouts, 20-day to 50-day breakouts, probably lost a lot of profitability, trying to choose my words carefully, and the 100-day plus breakouts became necessary, let's say. I know everyone doesn't agree with that. And the 100-day plus breakouts, if you do the back test, they were always wonderful, back even into the 70s. So anyways, this is the one thing we have to keep track of as traders. How do we stay in these trends as long as possible before they turn around, and we participate in these outlier moves, these, I'm trying to remember, I think it's exogenous. No, wait a second. It's one of the two.
Endogenous.
Endogenous. I would have gotten an A plus in Richard's class like 6 months ago, but I can't remember what I learned 6 months ago sometimes. And so then we participate in these, and then all of a sudden at the very end, they collapse, which can happen. But maybe when they collapse, it's more of an exogenous, the smaller percentage, the 10 or 20% of the big trends are the ones that have a tendency to collapse. I don't know. It's just something to keep in mind, and one of the great things about trend following is that you cannot predict what's going to happen in the future. You cannot predict the fundamentals of the markets. You cannot predict the patterns. The historical patterns in all of the markets are not to be trusted. The historical pattern in any certain market is not to be trusted. This is a bad market. Well, it may not be in the future, and vice versa. These are not to be trusted. The thing that I trust is giving these breakout entries and exits, what does my average trade look like? And then, so I'm going to be confident going forward that when I apply this system to any trade, brand new markets or old markets, historically good markets or historically bad markets, my expectation for the future is the same for each trade. That's what I've got to concern myself with. But I don't think it's anything we should shy away from, that these markets might change, and and this is what I really focus on, is my system taking profit out of the markets like it should? And then if we get into a situation where the markets become less choppy and short-term trend following works well, that's great. We can go back to being shorter term, and we can go back to smaller drawdowns. Or if the markets become more choppy, we have to extend our parameters even more. Then we're more prone to these crashes, whether they're more prevalent or not. We're into a systematic approach that is so long term that we're destined to have very, very big givebacks on the trades. But one thing I would just say is that as a guiding principle is don't ever think that your worst case scenario can't happen, and just be a man about it and say, hey, this is what I'm paid to do. This is what being a trader is about. is not changing my systems, not overfitting my systems for every little blip in the market, but to look at things holistically and say, hey, is this sort of time frame that I'm using I use multiple time frames. Are they still, viable and relevant? What made me choose to get rid of a 50-day breakout and go to a 100-day breakout in the 90s? That was a great choice. Was it luck? It wasn't much analysis, probably. It was just looking at charts and saying, hey, these trends tend to last for a year or two, and I'm not in these trends for more than 3 to 6 months. How has this performed historically? Oh, it's performed great. There's no reason not to change from the shorter term approaches that are not doing very well.
And I want to say that it's all great what you have said right now, and I want to say that I agree with 100% that choosing these markets, it's not the best approach to choose the markets to trade in terms of maybe correlation, but I think when we are limited, when we are, for example, have 1 million United States dollars only, we are limited 20-25 markets. We're forced to choose with the circumstances. I see such a thing, a little common sense, I think so. And I think if I have only 20 markets to choose, I probably will not choose the market that for 20 years or for 25 years wasn't performed because there is a certain reason for that, and that is only probability. Maybe I'm not right here, maybe, but I think the less amount of money you have, the more common sense you must use here in choosing the markets, and maybe the more probability that you are wrong with this. So it's more better situation when you have more money in your account, of course.
Yeah, I had another related question, again with the cocoa and like markets being different or decorrelated. So we all agree that diversification helps. The more markets you trade, the better. My question with the people who enter trades with a fixed percentage of capital risk, so let's say 50 basis points or 1%. So if you have 1 million and you trade 20 markets and you have 1% maximum loss on a trade, it's one thing. If you have 100 markets and you still risk 1% on each of those 100 markets when you get a signal, I'm assuming the risk ramps up increasingly. And when you have 400 markets and you still risk 1%, you're probably going to blow up. So my comment here is, in order to hunt markets with outliers, so you're going to hunt more outliers in 400 markets than in 20 markets, I agree. But you have to lower your risk per trade with 400 markets to keep the volatility similar to as if you were trading 20 markets. So even when you catch those 3 or 4 outliers in the 400 markets that you otherwise wouldn't have caught with 100 or with 20 markets, the percentage of their contribution to your P&L will be drastically lower, much smaller. So how am I correct making this assumption?
No, not really absolute, because, okay, so you're right about as you increase levels of diversification, the idea is you should be reducing your trade risk as well. The idea being that because we are targeting these outliers, which are these non-linear anomalies, what we find is that even though we reduce the scale of our bets, let's say down to 25 basis points where we might be trading 100 markets, or even going lower if we've got more capital, and say we can lift it up to Jerry's level. I know Jerry's even gone lower than that now. I'm not sure, Jerry, you'd be able to tell me what basis points you're trading at the moment with your plus 200 markets.
15.
Yeah, so the idea is that each bet is very small, and because we are trading in these tail regions, we don't need to worry so much about correlations. Correlations is it tends to be a symptom associated with the bulk of the distribution of returns. Out in these outlier regions where we catch these huge outliers, and we are basing our trade risk on our realised capital, not on our equity, we are often carrying very large sums of unrealised equity. So our risk per trade on equity can be quite large, but that is all profit that we're risking. It's not our trade balance. So it doesn't really matter what size you get to with your bet size because it's all relative. In other words, if you trade with, say, 20 basis points as opposed to 100 basis points, the relative impact on your P&L is still the same because of the nature of the nonlinear anomalies against the linear bulk of the distribution of trade returns in your result. So it doesn't matter what scale you're doing because these anomalies are scale independent. So what that means is that as you're reducing the bet size and increasing your levels of diversification, you can be increasing the amount of outliers in your portfolio sample or trade distribution, and therefore that will inevitably lift your KGAR and reduce your drawdown, because you've got to realise that your P&L is a result of both your losses and your wins. And if your losses are going to be much smaller because you're trading much smaller, your wins are still going to be relative in relation to those losses. The relative R is going to be the same, or the level of ATR is going to be the same, the multiplier. So all it's doing is it's improving the distribution of trade returns, which is effectively a scale independent feature. I hope I've made sense out of that.
Yes, Richard, that made a lot of sense. Though I still don't. So this is how I view diversification. It's really interesting for me how you and Jerry have this view, and then I have mine, and so I'll try to explain mine. Why I would prefer to trade 400 markets versus 20 or 100 is mostly and primarily because if I'm trading 20 markets, then I will probably have 5 markets per sector, per asset class that most of the time moves together. If I have 400 markets, I will have 100 markets in the asset class, and moving from 5 markets to 100 markets per asset class, for things that are relatively correlated or move together, will allow me to stay with the trend without being kicked out or stopped out. It will smooth out the volatility that the smaller amount of markets per asset will otherwise kick me out. So, for example, if I trade 100 markets, I may get kicked out of 20, but in the 80, I will still stay. If I trade 5 markets, I may get kicked out of all of them, and then I'll be done. If I didn't choose the correct 5 markets, or if I was lucky to cook the correct 5 markets that are amenable to my system or to my levels of stop losses and exits, then I would have outperformance to my competition. But preferably, I want to trade as many markets as possible that my capital and granularity would allow me to smooth out the dependence of my performance to such random events.
Yes, that's it. That's exactly right. Absolute. But that's one benefit of the diversification. That's the diversification benefit of basically risk minimization you're talking about. But there is another benefit of diversification, which is the outlier component. In other words, let's say you have a single return stream. Let's say it's the euro dollar. Over a 30-year history, that might only have 2 or 3 outliers, significant market moves that are outliers. And if, for instance, you invested a trend-following system into Euro USD, you'd be tempted, if you only traded a single market, you'd be tempted to overtrade that market, which is only delivering 3 outliers. So you're going to find that your trade distribution has a lot of noise in it with only 3 possible outliers in it. However, if now you increase your diversification to 50 markets, and let's say we don't know where the outliers are going to exist in any of these markets, but we do know over a long enough data sample that they are much more frequent than what a normal distribution implies. So therefore, let's say we diversify over 50 markets, which let's say on average have 3 outliers over a 30-year history. Because we are allocating over 50 markets with a greater level of capital, there are 2 things going on here. One is we've got to be more selective in the trades that we undertake. In other words, we avoid this over trading symptom with low levels of capital across a limited selection of markets. So we're only taking those signals that are material in nature over 50 markets. We're still capturing 3 of those outliers in each of those markets, but we're significantly reducing the number of losses associated with each of those markets. So our trade distribution is progressively distilling a higher degree of outliers in our portfolio distribution of returns. That's what's lifting the CAGR. What you're talking about is also reducing the drawdown exposure at the portfolio level because of the selection bias that occurs with only taking a small selection of markets. As you increase the levels of diversification, you naturally embed an uncorrelated symphony of different markets into your portfolio, simply by virtue of the fact that each market has a different signature, and by blending a bigger ensemble, you are naturally reducing the degree of correlation that exists in that ensemble. So there are the 2 benefits of diversification, which I think as trend followers we've really got to be aware of. I think most people only think in terms of diversification as a way to reduce risk exposure of a portfolio, but for a trend follower, there's another magnificent feature of diversification, and that is our ability to get more and more outliers in our distribution of returns.
Yep, I understood that. One comment to that would be, I would suppose, let's say the 2 outlier hypothesis for euro dollar is correct over 20 or 30 years. I would posit that when those outliers were happening with the euro dollar, you would probably have outliers in the 2-year note, 5-year note, the Bund, the Schatz, and the other 50 interest rates markets. So my argument here is that if you're trading all interest rate markets that are in some way related to the euro dollar outlier, are you talking currency or I'm talking interest rates? I'm talking interest rates, euro dollar interest rates. So when you're trading all of them as an ensemble is much, much better and smoother, and you're going to catch most of the profits that you will catch with 3 or 4 outliers that your strategy caught, but the 7 or 8 that your strategy didn't catch. If you build a strategy that will put you in all 50 and then maybe kick you out of some of them and then kick you back into some of them, and you adjust your interest rates exposure between 100 and 80% and let the market, the 50 markets, vote as to how confident you should be in this trend or not. I think for me, that's the beauty of diversification. Instead of
spot on, totally agree.
instead of looking at one single market and hoping, oh my God, I hope it doesn't hit my stop, and if it hits my stop, I have to get out. That's my strategy. Boom, and now it all comes back. But if out of the 100 markets, 20 stops got hit, 80 didn't, the market has voted. Yes, on those 20 you were unlucky, but on the 80 the stops are not hit. You're still in. You're still 80% into this outlier trend on the asset class, on the segment of the market. This is my comment.
Love it.
Yep, you nailed it. That's exactly what we say to ourselves all the time. And I would just say that I'm glad I didn't jump in ahead of Richard, but because that was a brilliant explanation. And but what Richard reminded me and taught me a few years ago, or whenever we started all this stuff, was that the reason we diversify is to take those small bets. And so we're going to get 5 to 10% of the trades, something like that, as outliers, I guess, depending upon your parameters. But so this is correct. We're continuing to trade a bit smaller. We're going to continue to trade smaller, but the more markets we add, we can actually trade a little bit larger. So if we trade 200 or 300 markets versus 50 markets, the total risk can be a little bit larger because of that added diversification, let's say. Not too much. But yeah, this is how it's so brilliant that we're basically, and then the correlation problems go away. I remember a few years ago, someone tweeted this in reply to something I had tweeted about correlation or risk. And they said, the correlation benefits or the problems that the errors that I might make in setting up my portfolio, depending upon markets being correlated or not correlated and how I handled that, it kind of diminishes with the more markets that you trade. Now, granted, that's true sometimes, but if all of the if all of the interest rates rallied, I'd get I'd lose some money like in July. And then same with the currencies. But, yes, letting those profits run and not scaling back based upon vol and correlation allows the yen to keep going and really dominate performance and really get the benefit of that performance, or the short-term interest rates that have had here up until now much larger moves than the longer-term rates. So continuing to scale back those trades based upon vol and correlation makes them look more like the sector themselves. So I think this is another thing we kind of probably don't all agree on, is that there's a big benefit to not scaling back these trades based upon vol and trying to classify risk as volatility of mega trade profit in trades that are tremendously profitable is kind of not a great idea.
All right. I had a if nobody has anything else to say, I had another thought maybe a week or two ago on scaling through volatility. The correlation I'm not too excited about. I don't use correlation a lot, so we shouldn't lump volatility adjustment with correlation, as far as I'm concerned. But with volatility adjustment, and this is also, I was gonna write you a note, Jerry. So think about how a long trend actually looks like. I've looked at a lot of charts and a lot of trends and how they look like. And to me, they look like they're breathing, like breath, in and out. So there's spurts of movement, and then there's a base and calm down, and then there's a spurt of movement, another breakout, and then there's calming down where there's like a whipsaw, and then some turn followers get kicked out, some don't, so my comment on the nature of trends and volatility adjustment. What happens when you volatility adjust in a healthy long trend? When a base is formed, when the market quiets down, volatility goes down, you adjust your size up. So as long as you're not kicked out, you adjust your size up, and you're waiting when the markets come down. As the market breaks out and more high volatility days fill up your lookout window, then your volatility starts to explode. As the market explodes, you slowly start to shrink. And usually when a trend, short-term, mid-term trend gets exhausted, volatility spikes. At the volatility spikes, you have your lowest volatility adjusted size. And then you have the lowest size. And then the exhaustion happens, the market now takes a breather, forms a base. As it forms a base, you slowly start increasing your size. As volatility comes down. Then another spurt happens. So if you think about this, if there's one big long trend, and you have two options, you keep your size fixed, 5 contracts, or you are let's say 15. And then when you're in a base, you're at 20 contracts, and as the market rallies and it explodes, at the climax of volatility, you're at 10 contracts. And then as the market bases, you go from 10 to 20, waiting for the next breakout. As the breakout happens, so this kind of adds This screws up the positive cueness. I agree. This adds a little bit of a mean reversion, but I think it also adapts to the natural way that the markets breathe. This is a comment. I don't know what you think about this.
I don't like it. I'm joking. No, I mean, no. Look, we're just in two different worlds, and so my honest comment is just that that's discretion, which is fine, not for me, but I mean, I don't want to say that you should, if it works for you, because I've already said that that's not a good idea, but it's either discretion, right? And something I'm not interested in, the market's breathing. No, sorry, not my.
No. This is not discretion. This is part of your system. You're just adjusting to volatility.
Right. Yeah, no, it's either discretion or, I was going to say, or it is systematic. And you're getting, and for me, it's too far, it's too many variables, it's too many parameters, it's messing up my sample size. I got 5,000 trades, which I'm not even sure is enough, with one entry, one exit, and a stop loss, and ignoring everything else. And then all of these conditions that I've got to write rules for, this is making me uncomfortable. So
no, I have less parameters than you, Jerry.
Well, all right. Send me an email. We'll talk about it.
Absolutely. One of the things that gets me about this whole notion is that, we talk about we're hunting these outliers. Now, the bottom line is we never know when we are riding an outlier. We only know that as a hindsight measure. We only know that at the end of, when we look at our portfolio distribution of trade returns and we see these 5 to 10% of stunning trades, and 90% of them have been basically losses, errors to us. They haven't caught these outliers. Effectively 30 to 40% of our entire trade sample might be wins, but a lot of those wins are unsubstantial minor wins, effectively random perturbations. Just as the number of very small losses we incur, 60% are these very small losses. But it's really only the 10%, the 5 to 10% that move the needle. And all of that is totally unpredictable. We don't know anything about the nature of these outliers. So by inferring that we can adjust our trade position size during the course of these trends, that to me is more a convergent statement. In other words, a statement based on our assumption of what volatility is going to do in that trend. I believe that as soon as we make that trade entry into a trend, our ability to infer anything about that nature of a trend, if we want to maximize our potential for unlimited profit potential, we've got to eliminate our desire to infer any information about what happens between entry through to exit. All of our risk, all of our bet is assigned on entry. At that point in time where we place our bet, the roulette wheel takes over for the entire course of the trade through to exit, because it's information deficient. We don't know how that trend's going to play out. Now, I've looked at a large number of different forms of outliers. Some can be parabolic moves, magnificent parabolic moves. Some take a more sort of a typical trend posture with breathing, as you talk about. There are so many different visual forms of trend. All of them potentially can be components of outliers. So for me, to infer any information about anything that occurs between entry through to exit is basically trying to assume there's more information than is what is actually present in this power law region, this region of this exotic anomaly where non-linearity, no central mean, there's standard deviations everywhere. It's more a Cauchy distribution. I personally think we think too much about getting information that simply isn't there in adjusting our position size, and that inevitably incurs additional trading costs if we are continually adjusting our position. So I'd much prefer to make trade an ensemble of systems at entry have my defined bet for my ensemble of trend following systems. Each of those ensemble of trend following systems is designed to capture a different possible trajectory of a possible, outlier. We don't know what trajectory it's going to take. And that is as limited information as I'm prepared to bet on when that roulette wheel spins.
Exactly. And you can, we don't know what happens when in any sort of trader when they underperform. And I never wish underperformance or troubles for anyone. But a logical explanation could be this type of analysis worked for a long, long time, and then all of a sudden it doesn't work, and the markets have changed a bit, and this sort of prediction did not harm or maybe actually help for a long, long time. Then all of a sudden, this here is the problem: is this lack of robustness, this trying to have the market and the patterns tell you something, give you some of this information. It can work or be benign for a long period of time, and all of a sudden, you sit back and you don't make or you lose. And the thing that would have worked a lot better was the simple breakout.
My response to that would be that volatility normalization actually makes the strategy and the results statistically more robust, because volatility normalization extracts profits from wider ranges of the probability distribution than hunting for just the 3 out of 100 outliers that may happen in the portfolio. Without volatility, as Richard said, so the 10% of trades contribute most of the profits. 90% are kind of wash or maybe a slight loss. Whereas when you volatility normalize, you spread out your profits across markets and across time frames. At least that's my experience.
I agree with that,
is
absolute, but I think you're borrowing from the bulk of the distribution to improve your profitability. But what you're also doing is you're sacrificing your outlier potential by a predictive assessment based on volatility of how to adjust your position size. So if, for instance, there will be situations where volatility can explode and change at the on a pin, by adjusting your position size. So if volatility goes up and you're reducing your position size, you are taking profits off the table, and that potentially can compromise your ability to capture that unlimited profit potential. So you are sacrificing a degree of positive skew to get a slightly more negatively skewed distribution by borrowing from the bulk of the distribution. To me, that is a measure of sort of like it's a compromise between trend following and a degree of mean reversion inserted into the premise.
Well, but I don't agree, and I disagree. I think it's back to what Absolute said. It's just a difference in philosophy, and I've tried to say this, and it's many times, and it's hard to. I can't find the perfect words, but it's all about the sample size and counting that sample size. And I don't know how to count the sample size of this continuous adjustment of positions based upon vol, or less than continuous. Maybe it would be a bit easier if it was just reduction trades, but entering and exiting and entering, it's very difficult to count. And it's absolutely not true that, what do I know? But in my opinion, that, look, we've tricked the numbers. It's not necessary or appropriate to separate those outliers away from the other trades. You segregate them based upon their profit. No, not correct. We include them in the sample size of 5,000 as legitimate members of that sample size of 5,000 because we use the same parameters to create those trades. So look, it's just a difference in philosophy. And I'm willing to change my mind, but I don't think I am. I'm too old. Plus,
Don't do it, Jerry.
plus I learned from Rich and Bill, and if they tell me to switch, or if I meet someone and hear someone tell me why that's incorrect, but it's the backbone and cornerstone of trend following, which is what you're trying to take down, which is fine. I mean, I have no trouble, but there's a lot of smart people who do trend following, but it is the absolute backbone of trend following. Can you pursue the outliers?
Jerry, do you adjust the position size dynamically?
Jerry's having a bit of audio problems, I think, at the moment.
Okay. Anybody hear me now?
Hello. Can you hear me, guys?
Yes.
Hello, Jerry. Hello, Richard. Hello, Oleg. Hello, Michael. Hello, everyone else. This week has been a long week. I was just increasing my portfolio size from 60 to 200. And when I was listening, Michael, who's planning to go on his own, trend following journey like I do, and I'm a new trend follower. I'm doing this for the last 9 months. Michael, I wouldn't really suggest you to trend follow just 20 to 25 or 30 markets, unless you really have to. And my humble suggestion would be to trend follow stocks, which are readily available, or just move on to Canada, because Canada and Australia and UK and Europe, we have the benefit of CFDs, and with it, I've started trend follow with 60K, 60,000 basically, and at the moment I'm trading 5 figures, six figures basically. And so with a much less amount than $1 million, you can actually trend follow hundreds of markets with no problem. But it's just, it needs to be done, in my view, properly. And if you cannot do it, there's no point forcing the commodities and the bonds and the rates. And, instead of going that route, stocks are available much more readily in USA, and I would say my humble suggestion would be just to go to that route. And so this is one point. The second point would be, at some point we've been talking about this position size and the leverage. This week for the first time I've added this Fed's fund rate, and I've never seen such a highly leveraged instrument in my life. So at the moment, I'm trading everything else with 50 basis points and the rates with the 10 basis points. So I'm definitely not, allocating the same risk to all the instruments, even though that's ideal. But if I trade it with 10 basis points, the leverage, as a quant, I'm looking into the notional leverage. So for me, the definition of a leverage is the notional leverage divided by the account size. So it takes 2/3 of my account, which I am comfortable with. But if I put, God knows, 50 basis points, the total notional size over account goes up to three times. Who would trade like that? And naturally everyone else. So I understand that people are much more comfortable, and Jerry Parker and Mike Shell and the other established asset managers are comfortable to trade the futures like that, which is the minimum size of 5 million. And when you multiply that, and calculate your position size, it's huge. So I'm not doing that. I've allocated only 10 basis points to the rates. So that is the second update. And the third part, which you've been all talking about, I love this volatility management conversations. I don't do it. It cuts the CAGR, and I don't think it's at the heart of a trend follower's journey. And as we've discussed here, there are trend following as an investment philosophy. We have the short-term trend followers like myself, and the long-term trend followers like Richard and Jerry Parker. And when people are actually talking about, we all know what Jerry Parker is and does, but for the rest of the community, this community is not only for long-term guys, I guess. So I'm here, and there might be other short-term trend traders. Michael is a mean reversion guy. Another thing that I wouldn't think that I would be touching any time soon in terms of investment philosophy. It just doesn't resonate having large losses and small gains, but it's definitely some of the good traders in the history of trading have used mean reversion and done very well about it. So I definitely respect the investment philosophy out there. It's just even Mike Shell might be using mean reversion. He was talking about trading counter trend, but it's just not something else that I do at the moment. That's the update from me this week. Thanks a lot, guys.
Got to be quick on your feet with Twitter Spaces. I'm not sure why I wasn't able to hear anybody, or it kind of bugged out on us, but it's kind of crazy. This has been more reliable until the last 2 weeks.
The time available now, maybe to an hour.
Yeah, it was about an hour and 10 minutes, I think. So maybe there's something to that. I guess they'll end up charging me for that, so that they have a new business model. Or maybe if Elon gets forced to take it, who knows what's going to change then.
I've got the recording session on anyway, Jerry, so I'm able to capture both these sessions. So I think we're going to find that the recording that Twitter Spaces does is only going to be for one of these things, but we'll see what happens.
Well, I was pouring my heart out to Absolute, so I need, I'd like for Absolute to push back on what I was saying.
Hopefully he comes back. But look, Mike asked a question while you're away. He was talking about chandelier exits. Can you explain your exit that you use for your systems?
Me, I use just the breakout exit. I don't like the chandelier or the moving average very much. Just the uncomfortableness that you get from the breakout makes me feel like it's a bit better. It just doesn't move up very quickly. It stays in the trades longer. It maximizes the profit and also gives back more usually. The chandelier is too clean and perfect and wonderful and beautiful, and that makes me nervous. And moving averages that you can, I don't like those entries and exits because I like to buy the highs and sell the lows. And sometimes I've seen on the moving averages, you don't sell when the market's going down, but then if it rallies for a few days, you end up selling there. Whoa, I cannot do that. So too much history. So I really like those breakouts. They're very beautiful, and they're very counterintuitive, and they make you really lose sleep at night. So it must be the right thing.
But Jerry, do you use those chandelier stops? Do you adjust the volatility, or the volatility you use is at the start of the trade?
Yes, just the volatility at the entry. So for each market, and once again, if there's anything to be gained by doing it different, it's okay, I suppose, to do things different, but just be consistent and do it the same way for all the trades all the time. So I don't think there's a lot of difference in the performance, but switching. And I've had situations in my code where inadvertently I was not treating the markets the same way. And we would do the back test and say, "Ooh, that doesn't look very good," because the computer will sniff out and penalize you for being inconsistent. I calculated my ATR stop in two different ways, and I told the computer, choose the highest number, because I wanted to be maximally conservative. And it comes back and says, you're going to get worse performance because you're simply not doing the same thing every time. And so subtle things like that can slip into the code, and the computer will tell you very clearly that it's not a good option. Or if you do things like that on the exits, on the trailing stop exits, it will tell you that it's wonderful because you've optimized the parameters, and it won't be wonderful in the future. So yeah, I just use the entry ATR, and I don't change it. Some people talk about changing the stop, to move it up to break even or lock in some profit. And I think another thing too that makes breakouts work and makes them so good is you always have that chance. I tweeted this the other day. I forgot what I said, but it was something like, you always have the chance with the proper trailing stop calculation, whether it's no matter what it is, chandelier, moving average, or breakout, to give back all of the profit or way too much profit. And you're sitting there helpless, following a system that you back tested, that you loved, that you said, this is it. Look how much money I'm going to make. All I need to do is follow this system. But in the heat of battle, you're being tested. And you look at those trailing stops and they're so far away. Now, they've always been maybe far away. And that's the reason you have this open trade profit to the degree that you have it. But now that you've made all of this money and all of your peers probably have a much better way of locking in profits, you're sitting there potentially having this big profit turn into a small profit, this nice profit turn into a loss. And without thinking systematically or mathematically, but humanly, you're like, oh, move it up to a break even. Or move it up. I'm not going to give back all. Everyone knows you should not give back all this profit. You know what? The computer doesn't know, because the computer told you to stay with that trailing stop, to stay with that stop loss, give that trade as much room as possible, because it's not about this trade. It's about all of the trades. So if you suck on 9 of them and give back way too much profit, according to your brain, especially compared to your peers, and then that 10th one takes off and makes way more money than you would have lost in those open trade drawdowns, there you have it. That's what the computer solves for. I'll show you how to make the most amount of money in your career, but I cannot help you on any one specific trade or year or quarter or month. But that's what we live for. These trades we're experiencing now, and this is the psychology that you have to overcome. Back to George's post, one of the last things he says is, bottom line, your temperament is an essential ingredient in the equation of market success. Yes, that's correct. But who's driving your system? Your emotions or the math? So change your emotions so you can pay attention to the math.
Oh,
That was
yes,
so
I
good,
remember.
Jerry.
It was wonderful, yes, and I want to say that for me personally, it was especially wonderful because I remember when I was listening one of the episode of the Top Trades Unplugged and Systematic Investor show. It was maybe 3 years ago. Yes, it was near 3 years ago, and Jerry said about a break. Don't even think in that way, in a direction of a break even. And I thought, oh, it's a genius, and I stopped listening because I wanted to think about it a lot. It's so genius, it's so great. Only this one sentence, don't think in this direction. I don't remember exactly because it was 3 years ago, but I remember that it was very impactful on me, and I started to do my back test according to this information. I started to think a lot. It was in December 2019. I was started to end in March 2020. March 2020, we all know March 2020. And this information, only this one sentence, helped me to be in profit in March 2020. Not this one, but it was very impactful, very, 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 very. I was very impressed, and I think about this often, and I'm very impressed on this.
Thank you, Jerry, for being so generous. Actually, you have been great motivation for me to get back to the futures and trend following. Yes, when we backtest, we have two main sources of curve fitting. One is the returns, the price in the time domain. Those are the paths that they are random, and also the volatility. And if we change the position size dynamically, that's another potential source of curve fitting, and even worse than fitting to trends accidentally. And that's how I see it. Thanks a lot again.
Hi, Jerry. Yeah, you mentioned you wanted to hear some response of mine, and I forgot what the subject was. If you can repeat the question.
Oh man. Well, it was like, I disagreed that of your statement about you actually have a larger sample size or more robustness by picking up more trades in different parts of the equity curve.
Okay, I got it. Okay, so yes, I had I thought of an answer, but yeah, something happened. So this is how this is for me. Statistical robustness is also related to how distributed your profits are across markets, timeframes, and whatever. And I'll try to give an extreme example to make my point. If you have 1,000 trades and they all make +1 or -1, +1, -1, +1, so they zero out, and then the 1,000th trade or one of the 1,000 trades makes 1,000. Okay, that's the outlier that you're caught in this sample size. You're stating that as long as you're following the same rules to create the +1, -1, +1, -1, +1, -1, and then the one big 1,000, as long as you use the same rules to create this sample size of trades, you are statistically robust and expect that you are having a profitable system because, yeah, you made $1,000. Is this correct?
Exactly. I wish I could have described my own thinking as well as you just did. Thank you.
Okay, so now I will ask you a question. So there's two systems. Two systems produce sample size of 1,000 trades. One of them was the one as I just described. The other one also makes $1,000. But those $1,000 are distributed from +10, -15, +30, -20, +40, -40, +30. So across the universe of 1,000 trades, there's maybe 40 profitable, 60 losses, 60% are losses. The profits minus the losses is $1,000. So in your opinion, which one of these two systems is more robust if the number of parameters is the same?
Well, I think it depends upon the sample size, but I will say that I prefer your system. If the sample size is the same or better, I definitely would prefer ease, comfort, and pleasure. It's just that I have no experience being successful with something like that or finding something like that. And so it's not really a question of which one's more robust, because I definitely think it all revolves around the sample size and not the other stuff you were saying.
Well, I would propose that it is about statistical robustness because the odds of your 1,000th trade that made you $1,000 being in your sample or out of sample are much higher then the odds of my 40% profitable trades non-existing in the future world, where markets are more like cocoa, less like cocoa, they're 90% of them like cocoa, only 2% are cocoa, there's no cocoa, they're all trending nice. So
No,
I'm saying
I
a
agree.
system that can capture more possible future universes is more statistically robust than a system that is very sensitive to future outcomes, that is very sensitive to whether that 1,000 trade that made $1,000 will exist or not. Am I correct?
I don't disagree. And I just think it's up to you. It's up to everybody to find that and come up with something better than trend following that's staring you in the face, that it's easy to come up with. And
no, this is also trend following.
Yeah, but I'd like to say something here. It depends where you're drawing your distribution from. So it's very easy in the high frequency trading world of the intraday trading to develop a sample size of 1,000 trades. In our medium to long term world of trend following, where we're targeting the tail region of the distribution, we're drawing on that distribution of returns that is on balance non-normal in nature. If the distribution we were trading had an equal distribution throughout, then sample size has statistical validity. However, we do know that in these tail regions where serial correlation clusters, you need to draw your sample from the tail region, not from the entire distribution of returns. For our models, we're only participating in those trades when they are getting towards the tail region. So we are drawing on a part of the distribution that is different to the bulk of the distribution. So you can't really use sample size as a proxy here. It's a bit like saying, if I have 1,000 trades in a high frequency intraday trading strategy, I've got a robust strategy, but that might only encompass 1 week's worth of possible market regime. We know that markets are non-stationary in nature. They evolve, they adapt. When you therefore draw on a distribution of simply of the tail regions over a 30 to 40 year distribution, you are changing the nature of the distribution drawn from the total population, and it's a much more rigorous method with high sample size with our method, because we are drawing on a far reduced subset of possible price outcomes being in the tail region than the bulk of the distribution. It's totally changing the flavour. And so when we're talking sample size, we've got to be careful about which area of the distribution we're talking about.
Well, I mean, when we were talking, I think Jerry's definition of sample size is number of trades. So all the trades that are in your backtest over 30 years, all trades over all markets. So
yes, but Jerry's talking about a system he's deploying. When he's talking about his trades, he's using a breakout method that might be 100, 200 day look back. That's therefore excluding a hell of a lot of price data before his entry signal gets hit. Therefore, his distribution of trades is coming from a different area of the market distribution of returns. It's not necessarily that distribution is not evenly distributed throughout. We're getting a different state of the market. There are 3 states of the market. There's the noisy market, the efficient market, there's the convergent market, and there's the divergent market. He's drawing on his distribution from the divergent region of the distribution, which is a different kettle of fish in terms of sample size to someone who's, say, drawing on a distribution that's around the equilibrium of that distribution.
Well, okay, so no, my comment is that let's say over 30 years, Jerry had 1,000 trades and I had 1,000 trades. So it's not like the other strategy is trading more or more frequently or whatever. So let's assume that the sample size of trades is the same. So the frequency or whatever over 30 years is the same. And my point with this extreme example is I'm not saying that this is how things are in reality. Like, 999, 0 trades and then 1,000 or whatever. I just made 2 extreme examples of 30 years, 1,000 trades, 30 years, 100 markets, 1,000 trades, let's say. And then one distribution was 999 plus 1 minus 1 plus 1 minus 1, which is 0. And then one trade is $1,000 profit. And the other one, as I described, was whatever, 60% are losses, 40% are wins, and from different markets, different time frames, again, 1,000 trades, but again, $1,000 profits. In my view, this is mathematically more robust. And the second strategy is actually prepared to be profitable and not get killed by a wider universe of future outcomes, of future market outcomes. This is my statement.
But if that was the case, you'd find that those with a very large sample size, those traders with a very, very large sample size should have a very long-term track record. And I'd say, well, that's actually not the case. You know, when you look at who has the longest track records, you know, if you go back 30 years, you find that trend followers have been alive and well over a 30-year period. You find that mean reversion methods that might have a very high sample size are only sort of profitable over a 5-year period when that regime is suitable. And mean reversion encourages you to increase your sample size because you're trading on a predictive oscillation or a predictive pattern, and it allows you to increase that sample size.
Yes, I agree. Although I wouldn't say volatility normalization is mean reversion. It's only mean reversion compared to not adjusting to volatility. But in a volatility normalized world, I'm still in a trend and I'm adjusting for volatility in a volatility normalized world. I'm still riding the trend. I'm just adjusting for volatility. I'm not mean reverting. I'm not selling the top. I'm not getting short. So I disagree that people who adjust for volatility are not trend followers. I am philosophically a trend follower, both in trading and in life. I am a trend follower, and I'd like to be accepted in the club, even though I adjust for volatility.
You're in the club, absolute. No, look, this is just a bone of contention between two philosophical viewpoints. Jerry and I are what we call extremophiles. We sit on one side of the camp, and then there's you and a lot of others who sit on this other camp. I've really got issues with that other camp, but that doesn't necessarily mean you're not a trend follower. So welcome aboard.
Okay, yeah, I was half joking, but yeah, thanks.
Yeah, I agree with that as well. You're definitely in the club. But if I could just have the last word, and then I can go off and do my real job, I would just say that we'll talk about this again, because you're bringing up some really good ideas, and this is getting beyond our kind of historically boring discussions we have on vol management. And I do think correlation management figures into it as well. It certainly does for the majority of CTAs. But I think the thing to think about is counting those trades when you vol adjust. How do you count those trades? You know, because you have to put the entry and the stop loss, that's in a bucket. The entry and the trailing stop, that's another bucket. So you have lots more buckets. So you said we both have 1,000 trades. So I think that that's not the end of the statement. It's I have 60% of my trades are in the stop loss bucket, 40% are in the trailing stop bucket. So you have many more buckets. And maybe also number two is we can talk about next week the idea that if things don't look similar in the future to the past, is which idea of vol adjusting or not vol adjusting is better suited for that. But thanks for all of that, and you're definitely in the club. Please come back, Michael. Come back. It's been fun.
Thanks, Jerry. Thanks for arranging all of this.
Yeah, everybody, I've had a good time. The 2 hours go by so fast. So have a good weekend, everyone. See you next week.